There we go. All right, so the first big question that we're going to talk about is how you should finance your protocol. Let's go to the next slide. Now, it really, just like most strategic questions, it's going to depend on what your specific goals are. Next slide. I made these slides with like very little text, so we're going to be going quick here a little bit.
This is a great practice for a pitch deck too, though. Just keep it simple. Yeah, love it.
Thank you. Yeah. All right. So the two main paths available are to do one or more very large rounds, something like high seven figures and up, or just do one or even zero small raises of less than 5 million or so. Let's go to the next slide here. There's no one right answer, and that's important to remember because both options have advantages and disadvantages. Next slide, please. Thank you. If we look at the big fundraisers, they're going to do a few nice things for your protocol. First of all is that they give you a really large runway. Sometimes protocols manage to get 5 years or more of runway if you manage your spend correctly. These big fundraisers also tend to drum up a good amount of free advertising from the articles that get written about them, and people like to talk on Twitter about these fundraisers. And finally, if you do manage to raise a large round, it is very likely that you will have secured a 9 or even 10-figure launch valuation. And at least on a personal level, that tends to be a very big win. But the negative side of a large fundraise is that it's going to come with much, much higher expectations for product quality and user traction. So if you launch and the product comes out and no one starts using it, or the product is of low quality, you can be in big trouble. It's going to be difficult to recover from that. The other thing is that you're going to be giving up more control of your protocol and the decisions you make along the way, because basically investors are going to be, they're going to be much more involved if they give you, 10, $20 million versus if you raise, 1 to 2 or maybe 3 million from a smaller number of VCs or maybe even from angels. The other thing about large fundraisers is that they tend to encourage teams to overhire and, frankly speaking, waste money on marketing. And the optics of that are not always great. And when you combine all of these elements, it can lead to a poor reception in public markets, especially over the longer term. And, for most of us who have like long vesting periods of, like 1-year cliff and then 3 or 4 years of total vesting, it really does matter that people continue to be interested and use your protocol over time. Otherwise, like you may maintain a certain valuation, but there's just going to be so little activity on your chain that that valuation is really going to be kind of an illusion because there will be very little trading activity going on. Now, if we look at smaller raises, on the other hand, they're going to give you substantially less runway, obviously, but they are going to give you a lot more freedom to make your own decisions. You won't have investors on top of you every day trying to sort of micromanage things. Now, you might still have some micromanaging from some investors, but overall, the amount of pressure from them is going to be lower. The other thing is that, having a smaller runway it's more stressful, of course, right? Because you're on borrowed time in a sense, but I think that in some ways that can be good. It tends to make teams more efficient. And I think that the constraint of having a short runway encourages resourcefulness. Teams that raise small or no rounds, they have to generate user interest with their product. They can't rely on fundraising announcements and marketing spend and conference booths and events. They really have to go based on real traction. Now, it's a lot more difficult, of course, but when it works, I think it tends to do much better in the long run. So let's go to the next slide here. really like the best path for you is going to depend on the characteristics of your protocol. So the next one. So based on what I've seen, the protocols that benefit from larger raises tend to be ones which are genuinely novel. This might not be a perfect example, but something that I've seen that has had success are like L1s that have brand new designs. Maybe DeFi primitives, like a truly new DeFi primitive might also benefit from a large raise because they basically get this free marketing and that gets people more familiar with this new idea. So if you have a truly novel idea, something that has not been done before, or at least like you're doing it in a very different way, then a large raise might be better for you. And the other thing to keep in mind here as well is that oh my goodness, I lost my train of thought. It'll come back to me. Let's go to the next slide here. So on the other side of things, if your protocol is just an improvement on something that already exists, it's probably going to be better to go with a small raise or none at all. I think the best example of this that we've seen recently is Hyperliquid. These guys did very little VC fundraising, if at all. I think they actually raised zero. And clearly they're doing quite well. But the important thing was that they had a product that was extremely successful. It wasn't like a groundbreaking product in any sense. It's a perp dex, like that's something that we've all seen and used before. But they did it very well. And, to me, they kind of ran the perfect small fundraise playbook. And my thought from before was that, I'm presenting these two options, right? Large fundraise versus small fundraise. I'm assuming you have that option. The reality is that not everyone has that option. And, in order to do a large fundraise, your idea needs to be capable of achieving a certain valuation. Like you're not going to be able to raise 30 to $50 million if the highest valued protocol in your sector is 300 million FDV or 500 million FDV. The ideas that can raise a lot of money, they tend to have comparable valuations well into the billions. So that's why I'm saying that these sort of novel ideas tend to like be capable of raising these larger rounds, and they can get away with it more. Whereas if you're a DEX, if Hyperliquid, for example, had raised 50 or $100 million before they came out, they probably would not have been doing as well as they're doing right now. Now, granted, Hyperliquid still has a lot of traction, and so they would have done well, but probably not quite as well as they're doing right now. I think they're around 13 or 14 billion FDV, which is super duper impressive for a DEX. So I think that that's a really good example to look to. But yes, you're going to be limited by the comparable valuations in your sector for sure. Next slide. So the second big question that we're going to be talking about is how you want to value yourself at launch. Next slide, please. Yeah, and just like with the fundraising, there's two main paths. You can either go as high as possible, go for that max FDV at launch, or you can try to launch at a discount. It could be a large discount. There are fair launch protocols that try and basically make it so that public investors can get in at the same or even lower valuation than private investors, or it can be a somewhat smaller discount, maybe somewhere between 10 and 30%. Let's go to the next slide and we'll get into the pros and cons of each. So yeah, just like with fundraising, each one has advantages and disadvantages. I would say here that, and Albert and I discussed this the other day, the most important thing to keep in mind is that valuations tend to have some inertia. All right. So something that comes out at a 1 billion FDV is likely to stay in that ballpark for quite some time. And the same protocol launched at 100 million FDV might never reach 1 billion FDV. I think that this is just something to do with human behavior and kind of like our tendency to anchor to a certain value. Like if someone paid a billion for something, then once it hits 300 million, people start saying, "Oh, well, it's a good deal." Um, Whereas if it launched at 100 million, if it gets to 200 million, people might be hesitant to buy there because they say, "Oh, well, it was only worth 100 million before. Now it's double. It's expensive now." Um, it's not necessarily a rational belief. Like there is a value that it has. There's like the correct price, but definitely people's psychological biases play into this in a big way. So that's really important to consider when you're thinking about your launch valuation. Um, it matters a lot for you. It matters a lot for your early investors and also for your future financing needs because, ultimately, if you have a successful token launch and your treasury, your protocol treasury has a lot of these tokens on the balance sheet, it's usually a very useful way to tap into additional financing later down the line. Rather than going to VCs, you can just sell off some of the protocol treasury, and there you go. You've financed your operations for some time now. So like in that sense, going with the very large initial FTV can be very helpful. But if you go too big, then it can hurt you in the long term because your users might feel that the launch was unfair. Uh, so and granted, it all depends on how your token does after the launch. Something that comes out as very expensive but does very well might be considered to be very fair. Whereas something that comes out what you think at what you think is a cheap valuation, but then does badly, even if you were trying to be fair or you're trying to give a discount, if it does badly, people are going to say, "Oh, well, it was unfair. You know, they went too big." So it's a tricky question. I think that it's very important to be honest with yourself about kind of where you lie in relation to other protocols that are kind of like yours, and also where you guys lie in the market cycle. Um, I think right now, uh, new token launches are being valued fairly generously. So if you were going to be more aggressive with your valuation, or if you wanted to do that, then now might be a better time to do that. Whereas, 2 years ago, or even 1.5 years ago, going with an aggressive launch valuation was probably not the best route. So let's go to the next slide because I want to show a very simple illustration here. And like this is kind of this sort of encapsulates this idea. Here we just have a chart with two lines on it, one starting from a higher point coming down, and one starting from a lower point and going up. This is basically your two options. And the question, we're asking ourselves, which one of these is better? Well, it depends, better for who? That top line is worse for public market investors for sure. And it's uglier, right? It doesn't look as nice as the green line that went straight up. But if you notice that red line ultimately ends up at a higher valuation than the bottom green line. So I think that this kind of shows the two scenarios where you go too big or you start too small. You don't want to do either. You want to try and end up
No green
right
light,
in the
no
sweet
escape.
spot. Sorry?
I think that was a hot mic.
Okay. All right, let's go to the next slide. So I think that a useful reference is to look at traditional IPOs in like equity markets. When they run an IPO, the investment bank will basically call up a bunch of investors like hedge funds and pension funds and this kind of thing, and they will sell, a certain amount of shares to those investors. And generally, they will price those shares at a pretty decent discount to fair value. It's not a huge discount. It's not like 80%. It's usually like 15 to 25%. And that's why you see on day one of IPOs, typically the stock will be up like 20% that day or 15%. That's because they purposely price the IPO cheaply. Now, if you're just like regular Joe Schmo investor, you're probably not going to be able to get access to that IPO, like at the actual, IPO price, because like the second that it starts trading, it will trade up. Now things are done very differently in crypto, right? So you can actually give public investors that 15 to 25% kind of like discount. But it's like, I think that this is sort of the sweet spot of where you want to be. It works reasonably well in IPOs, and I've seen, I actually feel like it's not all that popular in crypto yet to do it like this. People, tend to lean more towards the aggressive side and price higher, or they price way too low. So if you're gonna go for a discount, I would probably try it. If I were in the shoes of a founder, I think that this is the approach that I would try and take. All right, so let's go to the next slide here. So I just want to sum up the basic points that we talked about here, and then we're going to be able to get into a Q&A and maybe hear about more specific examples. But really, the bottom line here is that even if you can raise a lot, you probably shouldn't unless you have a genuinely novel protocol that would benefit from that extra PR and that extra runway. And you really need to be honest with yourself about whether your protocol is something that is like an improvement on existing products, or is it truly a new product? And then the second point is like your launch valuation should be fit, like it should try to be as fair as possible to everyone involved, but it needs to be fair in like a risk-adjusted way for each group of investors. So I'll give you one example. Like I've spoken to protocols that raised at 30 million FDV, and that was like pre-product. It's just the idea phase, and this is like a promising team, and then but still very risky. So it's something novel. They don't have that much built, but again, it's a good team. That protocol, they later on, like 2 or 3 years later, after they actually built everything and had actually proven that it could be built, they talked about doing a fair launch and trying to go at a 30 million FDV on launch. To me, that is not fair. Like it's not fair to the early investors, because the early investors took a much larger risk when it was just an idea, and there was nothing built. So to give like this obsession with giving people a fair valuation at launch, like I want it to be fair, but you can also give away too much for sure. Like people in public markets have unreasonable expectations about what they can buy at what valuation. So I think that public market investors are reasonable enough that they can see when something, like they can assess for themselves whether something is fair or not. I think that you just want to be able to accumulate, like a fair launch to me is something where you're able to accumulate it in public markets at a reasonable valuation for a reasonable amount of time. I think that going through all these hoops of oh, it's going to be a proof of work token that, no investors or insiders have access to, everyone has to mine it, blah, blah, blah. Like, this to me is going way too far in the other direction because you're essentially rewarding a bunch of people that took no risk. I think that there is a middle ground where, like, the people who took the most risk are going to be rewarded for that. And the people that are taking less risk, they're still taking a risk, right? So they can still get rewarded. And that's why you're going to not launch at a crazy valuation. But it's not going to be the exact same valuation as day one folks. So yeah, I think that the word fair gets thrown around a lot. But it really depends on your perspective. All right.